Well, our next guest says go against the market and buy into technology, even though the sector is the second worst performer on the S&P so far this year. He's Brian Belski, back with us, the Chief Investment Strategist at Oppenheimer. Brian, great for you to stop by.
Thanks for having us.
So before we get into technology, though, I want to just ask you about Alcoa's revenue miss. What does that tell you?
Well, we're not going to comment on specific stocks. However, the earnings part of what we've seen so far and what we expect to see, we think is still going to be pretty good given the fact that pricing has returned to the sector, right? That's the key thing. Last year, many of the material stocks did not have a lot of pricing. Now pricing's come back because the raw materials come up. So I think many of the analyst numbers might be too low. With respect to revenue misses, some of that is very short-term sided. Revenues can be very, very volatile over a quarterly basis, but the earnings trends are much more positive.
So good for them, but bad for some of the consumer stocks then?
Well, it could be, but there are some consumer stocks that actually benefit and are able to pass along higher costs, and people kind of forget about that. You have to go back to 2007 and 2008 to find those kind of names at work.
The mining stocks had a great run over the last, let's say, 12 months, but this year they actually are not doing as well as some other groups out there. So even though maybe the pricing power is there, the market doesn't seem to be in love with this group anymore.
Well, remember, stocks lead earnings, which lead the economy. That's kind of the way that it works, the circle of life. And stocks have done a great job discounting what's coming in materials, and that's probably why you're starting to see a slowdown. We're officially market weight, so neutral to the material sector.
Well, when it comes to the earnings picture overall, there are some of your strategist counterparts at competitors who are saying you might want to protect yourself going into this earnings season. Things like higher commodity costs could weigh on earnings and even cut forecasts. Now, what do you guys think? I mean, do you think the earnings picture is going to come in better? Like you said, stocks lead earnings, which lead the economy,
Well,
right?
That's an interesting comment because, number one, we can't speak to why some other strategists might be changing some sectors around. What we can speak to and how we get to our sector opinions, number one. Number two, we have been extremely bullish, as you know, for 2009, 2010, and maintained our bullish stance all of last year when many of my competitors turned very bearish in April and May, if you remember, right? Then everybody turned bullish again in November. We maintained our bullish stance all of last year. Now, this year, we're saying single-digit gains, and we've been universally panned as being bearish. Now you have some of my competitors are trying to be a little bit short-term. Oh, let's downgrade this, downgrade that.
Didn't you say we're on the precipice of a secular bull market?
Absolutely. We're on the precipice of the next great secular bull market. Over the long term, over the near term, you have to think about history and where we've been in the cycle. The stock market's price has already doubled in 2 years. Remember the premise?
Staggering.
Stocks lead earnings, which lead the economy. There's absolutely minimal history that shows that we can have 3 double-digit returns coming out of a recession low. There's no history of that. So why is it different this time? So I always get nervous when I hear it's different this time.
Right.
Global economy, all this kind of stuff.
Let me just talk about technology real quick because it's gotten beaten up over this past year so far. Why do you say that we're at a turning point?
Well, let's circle back to the comment about some rotating. If we're going to rotate into the defensive sectors, which many people are saying, staples, healthcare, telecom, utilities, we don't think there's a lot of fundamental merit for the long term. When we try to invest in something, we want to look for the next 12 to 18 months. We can't whip around sectors. And oh, by the way, investors don't either. That's the reality. The reality is, from a longer term fundamental perspective, if we want to perform along with the next great secular bull market, which is coming, we want to own some of the best sectors. And the best sectors in terms of our fundamental work, industrials and technology. We think too many people are wrapped up into thinking about tech the way that tech used to be in the late 90s.
Well, what is it, a valuation story, or is just tech so undervalued right now that it makes for a good story, or is it because of real growth prospects?
Right, it's a 4-pronged fundamental story. Number one, valuations are trading at a discount, which there's not too many sectors that are doing that. Number two, in terms of earnings growth, still is robust relative to the market. And here's the kicker. Earnings stability, meaning the volatility of earnings growth has dropped dramatically. Number three, it's a cash story about it, liquidity in terms of cash percentage of sales and free cash flow. And then number four, just the macro trends. We're seeing a replacement cycle in terms of inventories are coming back, cap use coming back, and pricing's coming back as well.
Isn't that part of the earnings, I'm just taking a guess here, the earnings stability part of that picture because the industry, or the whole entire sector is maturing?
Yes, and that's okay.
And that's the risk that people see?
Well, that's okay. It's the risk because people get so excited about tech being the next great big thing, because when you think about tech, you think about the go-go 90s. You don't think about how these companies, from a structural standpoint, have completely restructured themselves in terms of corporate management, in terms of cash balances, in terms of diversified product lines around the world.
Bank of America's Brian Moynihan is trying to ease concerns about his leadership style. According to Chairman Chad Holliday, Moynihan requested an internal audit after a lack of communication plagued the bank's recent SEC filing over dividend increases. Remember, the Federal Reserve objected to a dividend hike at the bank following a so-called stress test, while the Wall Street Journal reports that two top B of A officials, including the CFO and also the chief accounting officer, did not see the document before it was filed. A company spokesperson told the Journal that the pair weren't deliberately excluded from the filings, but that questions are now being raised about Moynihan's leadership style. Holliday says he's confident that Moynihan is making good decisions, but still leaves open a lot of questions about what is going on with communication there. We're back now with Brian Belski. He's the chief investment strategist at Oppenheimer. John and Dom with me as well. And, you know, this story, which is an interesting side story about Bank of America, is just sort of one of many, right?
Right.
Where you've continued to hear about uncertainties at these banks and what's going on as they're trying to struggle out and recover.
Well, 2009 was the great reallocation trade, right? In the first quarter of 2009, less than 3% was the average position of a large cap portfolio manager in the U.S. of banks, and they went to 15%. Think about in one quarter. Think about that huge move. Now, basically, financials have been flat. Right? And you have the specter of reform coming, because it's still coming. So think about what the government's had to deal with the last few years. Recession, healthcare, shutdown, the issues in the Middle East. Keeps getting pushed off. So it's still kind of hovering overhead. That's why we don't think that financials are prepared to lead this next bull market, as everybody kind of thinks financials need to lead, and they're not prepared to do so.
Well, to Brian's point, earlier this year when the Fed said, okay, you can put some of that cash to work, we saw the banks buy back stock and boost dividends. JP Morgan, the day they did that, stock went up 2.5%. Since they've done that, the stock's gone up 2.5%. The S&P has gone up 3.5%. Right. In other words, after that initial enthusiasm, investors have gone back to not buying bank stocks.
Well, you think about kind of the fundamental reasons to buy banks in the first place. That we grew up in the business over the last 20 years. You buy banks because they're buying back stock and paying dividends and buying other banks, right? Well, most of the banks, excluding a very few, aren't able to do that quite yet, right? And so from a longer-term basis, we think it's still going to be at least 2 to 3 years minimum before you start to see the industry in general, the bigger banks, begin to do that.
And that's simply because of the economic recovery.
It is because the lack of loans. If you're a parent, you'll know this term overcorrecting. Sometimes we overcorrect on our kids. Now our industry's overcorrected. Now we're not loaning like we should be loaning.
No, those volumes with loans, are they going to be an overhang for quite some time? Are we talking months or years to come? Where's the puck going to be, so to speak, in the next year or two?
Where the puck's going, right? And where the puck's going is it's going to take and continue to take a lot of time in terms of the compliance and the paperwork, and that's what's kind of slowing things down because, again, we've so overcorrected now. We are now, as a banking industry, meaning the broader, more worried about risk management relative to wealth management, right? And so now we've kind of bogged down the system, which is just elongating the whole process.
Brian, one of the questions I raised earlier in the break was, volumes in the markets, right? They've been so low. At what point do they come back? Because even though you see this bull market, the volumes aren't there to support it.
We get all excited about double-digit returns in 2009 and 2010. Most of those returns from the stock market perspective was driven by institutional investors, whether or not they're hedge funds or managed accounts, big mutual funds kind of reinvesting back in equities. But until mom and pop America, I like to say in Topeka, Kansas, really start to believe that they should be buying XYZ company and start putting money into U.S. large cap mutual funds, we're not going to start to see the volume that we need to get things going. January and February volume was pretty good because people are starting to buy equity funds. March, not so good because we saw inflows to bonds again.
Really quickly, what gets them involved?
More positive returns and less volatility. Think about why people slowed down in March. Japan worries, Middle East. Now we're starting to see people become a little bit more defensive. Mm-hmm. America works on consumption and assumptions, okay? If the assumption is that things are getting better, they will start to buy.
Brian, thank you.
Thank you.
Great to see you. Brian Belski of Oppenheimer.